So, how do stocks and bonds compare in terms of returns? Over the long term, stocks generally offer higher potential returns than bonds. Historically, the stock market has grown at an average rate of around 8 to 10% per year. But remember, that's just an average. Some years will be much higher and some will be lower or even negative. Bonds, on the other hand, offer more predictable but typically lower returns. A 10-year Treasury bond might pay around 4% interest, which is lower than the average stock market return, but it comes with significantly less risk. And that brings us to risk. Stocks are generally considered riskier than bonds. The value of a stock can fluctuate wildly based on market conditions, company performance, and even investor sentiment. Bonds are generally more stable, but they're not risk free. Interest rate changes and inflation can impact their value. The ideal time to invest in stocks versus bonds depends on your individual circumstances, like your age, risk tolerance, and financial goals. Younger investors with a longer time horizon might be comfortable with a higher allocation to stocks, while older investors closer to retirement might prefer a more conservative approach with more bonds.